We've been hearing about the one big beautiful bill now for the last several weeks, and we're all wondering like what this means for me and my family, you and your family, that kind of thing. So CLA tax principal and CPA Charlie Heid is here. Thank goodness to save us today. Seriously, when this whole thing first broke, all the parts of it, and I was reading about them thinking, I can't wait to spend some time with Charlie and have him break it down for me. There's so many moving parts.
There are.
So let's first start with the deductions for tips, whether it's itemized or standard deduction. So basically, waiters, bartenders, hairstylists, like hallelujah.
Right, and there's going to be people out there who say, wait, I get tips, and the key is when you think about it, clearly food and beverage are going to get it. In beauticians, nail salons where you might tip.
The people don't even make minimum wage anyway, so this is going to be really special.
Correct. And so the way it's going to work is the tip income, you can deduct up to $25,000 of your tip income. And that's huge when you think about, somebody who's, getting minimum wage and then tip income. So.
The new deduction for qualified overtime pay. So basically, if you're getting overtime, in the past, that could be taxed, and now it's going to be taxed differently.
So overtime was included in your wages on your W-2, and you were taxed.
Sure.
Now, and remember, this is all part of the campaign promises. Tip income, the overtime. So the way it's going to work is your overtime pay for somebody working at Jeep Plan or GM, they will get to take a deduction on their return, $12,500 for single, $25,000 for married filing joint.
So there are limitations there.
There are limitations, and there are income phase-outs. So for example, on the overtime, if you're single and you make over $150,000 in a year, through wages, investment income, whatever, you're not going to get the full benefit.
See, what's nice about this is one side is saying only the rich benefit from this. But no, this is a thing that the grassroots working people
in our area,
ones.
tip income
Huge.
and overtime is a huge.
Yeah. All right, now, this is deduction for car loan interest on the purchase of a vehicle that was assembled in the United States. Now, a car loan, does this also include a lease, or you have to buying the car?
Buying the car. So you've financed the car. And when you think about it, we've all bought a car and did financing, but we couldn't deduct the interest because it was personal. Now we can, as long as the loan was initiated after the end of 24. So you took out the loan in 25. The car was assembled. Final assembly occurred in the U.S., you can deduct up to $10,000 of car interest.
Kind of a gray area, too, because some people, you may have a Honda or Toyota. It may have been made in Tennessee or somewhere else, in even Ohio. So you have to investigate whether or not that qualifies.
And the IRS is going to be putting guidance out. There's a website that you can go to with the VIN number. You can check to see if final assembly occurred in the U.S.
All right, now, there's a $6,000 deduction for people 65 and older. Is this what was supposed to be the no tax on Social Security?
Correct, because they couldn't touch Social Security. So they did an additional deduction for seniors 65 and older.
With the income limit.
There is an income limit,
yes.
Correct. So, but it's $6,000 for single, $12,000 for married filing joint, provided everyone's 65 or older.
Why couldn't they touch Social Security?
So you couldn't exclude Social Security from the standpoint that they wanted to just say the income's not taxable.
Yep.
And that was going to be a much bigger hurdle to overcome.
Okay.
Because there's a lot of rules tied to Social Security that they couldn't touch.
Okay.
So this was a workaround.
Okay. Charitable contributions deduction, this has been changed.
Yeah, so again, this is for people who take the standard deduction, which most of us do today, take the standard, but you still give to charities. But you weren't able to deduct anything if you were doing the standard deduction. Now you can deduct, if I'm single, up to $1,000 of cash donations. And if I'm married, filing joint, up to $2,000 on
Yeah,
top.
it did dawn on me, like, I do donations because that's what I want to
Correct.
support.
That is what
but
you do.
yet, there's no benefit from it. Well, now there will be.
There will
because
be,
the standard
correct.
deduction over and above on
Yep.
that. And also, the One Big Beautiful Bill has the Trump accounts. Explain what that is.
Yeah, so it's a new savings account. And it is going to be, you can contribute up to $5,000 annually to that. But here's the key. If you have a newborn in 25 through 28, the government's going to put in the first $1,000 into that savings account. And then you, parents, grandparents can contribute, but you're limited to putting in up to $5,000.
Does your head hurt sometimes thinking about all these new bills coming in here and all the changes?
This is just the tip. It was a 1,000-page bill, and I haven't touched on the more complicated things.
Well, I just appreciate everything the accountants do. They have a very, very tough job, and we sure appreciate you guys.
Thank you.
Charlie Heid, thanks for coming in today. Appreciate it.